Good afternoon. This is Ken at Tortoise Capital with a review of the weekend trading reports for February 10th, 2018. I'm going to be going through my usual weekend preparation process and routine here and noting symbols from the report or ideas or patterns that I'm going to frame later, and I'll be sharing those with the advanced swing trade course students and posting a video of that in our chat room as well. And so this is just an idea to give you an idea of what my preparation practice looks like. So, starting with the markets, then I look at sectors and then swing trades and day targets, and then I zero in on intraday insights for detailed preparation. So, bullish volatile conditions for market classification, long-term annual market condition using weekly RSI 14 is in the middle of neutral, overbought, oversold. Short term, we are in the middle of neutral also. Actually, more like the lower end of neutral. Looking at the market mosaic, price with respect to the 200-day moving average, red bullish at 3.04%. So we're 1% above the boundary condition for sideways. The 5-day slope of the 50-day moving average is red bearish, basically flat at 0.08. Strength of trend, the NDX is 25.6 neutral, and bears are in charge. Pardon me. Market is 3 times as volatile as it was just a week ago at this time, with the ATR percentage of over 2%. The risk index is the 30-period moving average of the VIX divided by the 10-period. That score right now is 0.625, so we are deeply into risk off. 1.0 is the boundary between risk on and risk off. That score of 0.625, when compared to the last 5,000 trading days, we find the average and standard deviation and compute the risk Z indicator, and that's minus 4.32. That's 4 and a third standard deviations below the long-term average. That's how volatile this market has been. This is a 90-day histogram of that indicator. When it crossed the zero line, we were on high alert for potential downside risk events or volatility events, and we curtailed a lot of our speculative swing trading, and we're prepared for short-term intraday volatility, and that's certainly what we got this past week. Historic levels of price movement. So the risk Z is certainly on my first page on my radar screen every day and every weekend report, because it gives some sense of the seasonality for volatility. This saved a lot of people a lot of money. Blended monthly rebalancing. These are the holdings this month. Rebalancing due on or about 1 March. In ETF2, theoretical exposure is 10% because of that harsh sell-off of this past week. These are the leading candidates, by the way, based on closing prices on Friday. Latin America doing especially well. What's interesting to note is that the leaders going into February are still the leaders after the sell-off. So, quick look at different portfolios in the blended monthly rebalancing. You can see the preponderance of positions in cash, meaning that they're under their 4-month moving average. Only Latin America, and then just a few of the XL series here, above that 4-month period. Moving average. Dow 30, everything except Boeing and Nike are underwater. Boeing, Cisco, Nike, JP Morgan, DuPont, signs of strength amongst the carnage. And those that were really weak remained really weak. General Electric, Procter & Gamble, ExxonMobil, Apple. Among the sector spiders, you can see the winners and losers on the 1 month and 1 week scores. Is this a changing of the guard, or will the previous relative strength winners lead the way? Well, it looks sort of like retail and healthcare services actually holding up pretty well compared to things like the energy sector, which got slaughtered. ETF Max. Again, these are the leaders from among the 500 or so ETFs in the large database we look at. Mostly volatility products here, but S&P retail certainly has had a nice run. You can see the weakness in oil. In the market health check, the vertical blue lines are 10, 20, and 30 days of look back, 40, 50, 60. These purple and red lines are price levels that have been support and resistance in the past. They will be price targets on the way down and price targets on the way up. Current price here is about 9% sell-off from the recent swing high. This got as low as, I want to say, about 12%. So we're showing it in 5% increments. So we are officially in a correction, although you can see that the panic and starting around to 5%. And when for those of you listening to the daily debriefings and participating in the advanced swing, we talked about a 3-day selling sequence of concern, fear, and panic, and I still think we're into the panic mode. What I'm finding interesting is that in the MACD histogram percent price oscillator, which is more than 3 sigma of adverse move, Friday's price action, that little healing doji, actually gave a bit of an uptick. So there will be some arguments and whistling past the graveyard of hoping the bottom is in here around 257 at the limit of the regression channel for the 30 period. So the closing price action is what would give us some pause. And we're just ready for more volatility. It's going to take a couple weeks for the memory of this to be papered over. ETF regional report, everything except Latin America below its 4-month moving average again. Inside the sector spiders, financials and discretionary leading the way. Staples, utilities suffering, although utilities actually improved their position as a defensive sector in this recent sell-off, suffering much less. So I'm hunting yield, and that remains on my target list. I will show my trade frame on that one in the chat room and for the swing course participants. Market health check, Latin America and Brazil leading the way along with Malaysia. U.S. generally still above average. Mixed bag in both Europe and Asia. The ETF top 30, based on that ETF2 lens, notice Brazil has moved to the top, Latin America, Chile, biotechs, Malaysia. Green and green are the ones that have been and remain relative strength leaders. This green and white are ones that are showing some strength. Big time volatility increase. You notice that VXX is now up to over 9% of ATR percentage. These are the top 30 based on average daily dollar volume and their relative volatility in terms of what makes them good intraday candidates. Will be very liquid and very volatile here in the green. Shifting to the daily, the overreaction systems firing. Most of these signals then are all because of strong correlations to the S&P. Just notice that Asia less Japan, Latin America, and the Euro 350 are not in that category. You can see the 10-day max pain. 4 of those 5 are very lucrative swing trades in the past week for us, along with Devon. Just about everything tests out well on the auto framer due to the slightly smaller range on Friday, and then the great distance from the 10-day high means mathematically just about everything is going to have to be auto framed better than 2 to 1. and here you can see the greatest, strongest ratios. 3M I find interesting. It has not been a big-time loser except in the last 10 days where it's down 12%. But it's 5-1, and it's both channeling and overreaction. So that's certainly one that I'm going to frame up. So I'll be looking at 3M. I like ExxonMobil. Off of this list, Intel, because of the channeling. Inside the ETFs, the 551W Latin America looks very interesting also. And Brazil, and that's already on our usual suspects, so we always frame that one every night. Daily pinch and stretch. The most positive Z stretch on a Z score basis. This is so all of them except the VIX are below the 30 period, but you can see that Nike, Brazil, Mexico, gold all held up pretty well. So I'm going to add Travelers and Nike to that because it looks like they had some relative strength and could be leaders in the next round. These are the symbols that are the furthest SDs below their Bollinger Band mean in the middle of the river, and further weakness in these makes them candidates for continuation. You can see that we've got materials and energy already on the list, and we're already doing the diamonds. Most expanded pinch box, this is the 30 days of directional moves and a very wide river, and so these have been very directional, so I'm going to add Chevron to that stack. We have a short on that one. That's a continuation pattern. And no super pinches. The closest one to it, gold and silver, and even oil is relatively close. So we're going to add oil. The auto framer, plenty of things to choose from. Look at the domination up in here of the materials and the energy sectors. So ExxonMobil, energy, oil exploration, and so forth. Coca-Cola, I'm going to add that one as a continuation play. We had good swings on that one earlier. Regression line fractal framework. You can see right now we're in the RLFF sector here. Top shelf are the ones that are the deep value plays, the most numbers of ATRs below their own RL270. Procter & Gamble, Coke, Johnson & Johnson. The most number of ATRs above their own RL270. Notice none of these are. Or correction, or none more than two. So Nike and Boeing. We're going to look at Nike, but Boeing. These are the relative strength leaders here on the bottom shelf. No squeezes, not surprising. You see the magnitude of that move, the magnitude of this fall. When it crossed its own 10-period moving average, when the slope of the moving 30-period regression line crossed its 10-period moving average, more than one SD from the long-term average, this was the alert for a change in market condition. And because it was almost 3 SDs above long-term normal, it was really overheated, and you can see with the magnitude of that. Of course, you already know what that's like. But that's the importance of this chart. That's why I look at it every day. We've been talking for a couple weeks about just how powerful that slope of that 30 was. It was one of the 4 all-time great ones over the last 10 years. And then the collapse came all the way back to the long-term average. You can see a couple different measures of volatility. This is 4, maybe even 5 sigma, and even just price, the standard deviation of price over the last 30. Some extraordinary moves. We had talked about the unusual nature of all 3 of the regression lines being above their sigma z-score of 1, and then notice the size of this collapse. And now we're still as far above the river as we were. We're now below the river. And this looks like a strong support level here at 255. So we shall see. More volatility coming. Shooting for about 268 in the middle of the river is a return to normalcy. The volatility, the S&P, and some holding periods. Just notice a quick way, if you want to look at the last 5 days, you find the smallest z-score, or the strongest z-score in here is Cliffs Natural Resources, gold at minus 0.61, so that's actually not painful at all. But you look at something like XLP with a minus 3 sigma, 3.3, that loss was extraordinary for a 5-day period for that symbol. So this gives sort of an indication of relative pain over 5 days, 10 days, 20 days, and 40 days. The failed stats, gain stats, and gap stats, and signal to noise really are just useful for some intraday trade framing for the day traders. The signal to noise ratio, however, is one where you get a sense of those symbols on their daily charts, which have that are mostly signal. So the larger the number means that most of its intraday move is directional, has large real bodies compared to the overall range of the day. So things, not surprisingly, these are good intraday directional candidates. So Boeing, metals and mining, emerging markets, energy, they tend to be very trendy intraday. Once they get going, they stay in that direction, and so it's more signal rather than reversals, which is what gives you long tails. On the other hand, things like treasuries, 3M, wind, travelers, these all have longer tails than they do the real body. And so so in terms of intraday movements, I like to target these that are in the green on signal to noise ratio. So emerging markets, will add that one to the list. And metals and mining. Gold and Latin America all have the least losses in terms of their swing z-scores. And that's everything that I want to take a look at for this weekend report. I have some preparation work to do. For those of you in the swing trade course, I'd like you to pick those. I'm going to frame all of those, and we'll look at it on the portfolio review, and you can compare your trade frames to mine, and then that will give us some more discussion points, which we will record for the swing trade course. So, Kennett Tortoise Capital, keep your risk measured and your powder dry.